Hello, hello, hello. Today we're looking at balance of payments for GCSE, the last ever course. So let's get into it. Here are the objectives today. You can pause them and take a look, but I would rather jump straight into it. So the current account, what is it? It's a component of the country's balance of payments. It shows trades between residents of the country and the rest of the world. So it shows basically how much is going in and how much is coming out. There are 4 parts to this current account. So let's break them down one by one. And yes, you absolutely have to know all of these 4 parts. First part, balance of trading goods. Physical goods, cars, shoes, batteries. Next, balance of trading services. What are we exporting? Are we doing finance, accounting, banking, that kind of stuff? These are intangible services, but they still have a lot of value. 3, net primary income. Let's say you have a property abroad and you rent it out to someone and then you send that money back to the country you're in. Decent, that's net primary income. And finally, net secondary income, which is more like contributions, donations, aid, that kind of stuff. And you see that they use the word net. This is just the balance of both, meaning if more money is coming in, you have a surplus. If more money is going out, you have a deficit. So let's be more precise on each one of these. So as I said, the first one are visible or tangible exports, the trading goods. Physical products you can see, touch, hear, smell. Here's a few images to help you out. Chickpeas, cheese, and shirts. Next, do you know what the top exports are in your country? Well, let's have a look at this for the UK. There's a lot of things on this list I didn't expect, particularly machinery and transport equipment. Pretty interesting to see that the UK is exporting a lot of these goods. Trading services that are invisible or intangible, like I said. So we've got accounting, finance, those kind of things. Website building, accounting, there he is. Investment. So which invisible exports do you think are biggest in the UK? It's probably going to be financial services, isn't it? Yep, right at the top there. Then we've got insurance and pension services, which surprised me. And a bit of travel and tourism as well. So yeah, the UK is a popular tourist destination, particularly for the monarchy. Moving forward, let's look at point 3, primary income. So this is money you're getting from your foreign investments. So before I told you it was having a property and collecting rent. You might have interest on some investments that you have, or you might have a separate wage from abroad that you bring over. That's your primary income, okay? In the US, here's an example. So the US, people invest a lot abroad, rent out stuff, and they get a lot of return on that investment. They get dividends from companies they've invested in. And they might buy bonds from other countries, bonds from other governments in other countries, and they get interest returns on those. And profits that they get from business operations for businesses they own abroad. Japan, here's an example of Japan. The Japanese government and people hold a lot of foreign assets and they get returns from those. So that makes up a lot of their current account, particularly interest and dividends. Germany also has this, except Germany has a lot of businesses abroad they get their profits from. And the final part is net secondary income. This is usually transfers or donations. One of the biggest ones is what we call is remittances, where let's say you have, like we see in Thailand, Filipino workers, they tend to send around 50% of their income back to their home country. This would be considered net secondary income. They've already paid tax on it and it's pretty much a donation. And then we have aid and government grants and stuff that go abroad. And like I said, yeah, the remittances from Filipinos overseas workers, it's very common in many countries. And you see places like Africa getting loads of foreign aid donations. So again, that's the net secondary income on the current account, the 4th part, and you do need to know this. All right, so let's move on with our richer understanding of the balance of payments. So we need to understand the difference between a deficit and a surplus. I did allude to this before. A deficit means more money is leaving, and a surplus means more money is coming in. And generally, countries look for a balance in the balance of payments, i.e., there's an equal amount going out as there is coming in. So to understand this, basically, you need to identify if something is going to be a credit or a debit in a current account. And without any financial management background, it's going to be difficult for you. But fortunately, I have a background in financial management. So what we're going to do is a method using T accounts in order to explain how this works and how it's measured. And I think this should help you in your exam, okay? Don't be freaked out. T accounts are just a way from the 1600s, or even before that, where money was recorded. And so let's say I receive money from somebody. I have to record that I've received it in my account, and I also have to record that they've sent it from their account. So I've got 2 entries, meaning that it can be recorded and verified at the end of the day without any discrepancies. We've got the person to and the person from. So For this to work, we just need to understand the basics of a T account for banks. If we look at this on the right here, we can see that we have a debit and a credit column. So anytime money comes into a bank, it's called a debit, okay? Anytime money leaves a bank, it's called a credit, and it goes on this side. Now, all we need to really understand is for the current account, the entry is always the opposite. So if we have a money in the bank account, it will be an opposite entry in the current account. And if we have money going out of this account, there'll be an opposite entry for the current account. I'll show you what I mean later, but this is just a quick way to understand what to do in your exams. Okay, so everything's recorded twice. If money leaves a bank, it's a credit. If money comes in, it is a debit, like I just said. So here is an example. I get $200 from a student called Rio, okay? So the money goes into my bank. Because it goes in my bank, it's a debit. And because it leaves his bank, it's a credit. 2 entries. Make sense? I hope so. Now, I pay $50 to Rio. Money's leaving my bank and it's going in Rio's bank. So if it leaves my bank, it's going to be a credit. If it goes into his bank, it's called a debit. So now I've got 2 entries on here. I've got the money that Rio gave me before, and now I've got the money I've given him back. And at the end of the day, what they used to do is they just used to put the calculation at the end where the difference is. Yeah? And that will show if you've got an overall credit or you've got an overall debit. In this case, I've made 150 off Rio and he's lost 150. Now, as I said, we can use this method to work out current accounts, okay? So let's have a look. So we have item from Spain, and Spain buys American wood for $500. We're just going to keep it all in dollars to make it easier. Now, for the American bank, Spain has sent American money. So money goes into the American bank, which is a debit, and it leaves the Spanish bank. Okay, so we've got 2 entries there. Makes perfect sense, right? But what we need to add is the current account box. Now, the current account is just going to be the opposite. So if money comes in America, okay, for 500, the current account inside America is going to show a credit of 500. Let me show you what I mean. So we just create an opposite account for each country. So money left Spain, okay, money out. And then we show that money going out in the Spanish current account. So inside their country, they've got 2 accounts. And inside the American country, they've got 2 accounts. That's why it's called double entry bookkeeping. So if you had an exam question that said, okay, Spain buy American wood, for the Spanish current account, what does that mean? And we can see money's out in their bank account, and therefore it's a debit in their current account. And for Americans, it's money in, and therefore it's a credit in their current account. Okay, next, rent income. Can you pause the video and have a guess at this? So Spanish people own property in America and receive $1,000 in rent. So the Spanish bank account is plus 1,000, which is a debit, and then they need a reverse entry in the same country. So the Spanish current account is going to be a credit of 1,000. And for Americans, they've lost 1,000 because that money's left the American account, and it's now registered as a debit on the current account. I hope this is making sense. Can you try this one? Overseas salary. So money leaves the American bank account, we give that a credit. It goes into the Spanish bank, we give that a debit. But it's also the American current account we need to check, which becomes a credit. And then we have to look at the Spanish current account, which becomes a debit. And yes, I did write GBP there, just ignore it. I should just put dollars instead. Next, net transfers. Americans donate to Spanish charities. So money leaves the American bank account. So we credit bank and we debit the American current account. And for Spain, they receive the money. So we debit their bank and credit their current account. And usually the exam question just asks you what's going on with the current account in whatever country it is. So if I put all this together, it looks something like this. Can you tell me if there's a deficit or not for the American accounts, the American current account? The answer is yes, there is a deficit because 1,200 has left America. And this is because 500 came in, 1,700 went out. So the Americans have spent more abroad. Okay, moving on. So this is a realistic example of the British current account. So actually you can see in the UK, we are exporting less physical goods than we are buying. What about our services? We're exporting more services, which is good, but it's still not made up for this gap, really, has it, in terms of how much we're importing. Then we've got primary income and secondary income, which we're giving out money, I guess, and also people must have properties in the UK where they're getting rental income, and that's being sent abroad. And secondary income, we must be donating a lot to other countries. So the UK has a massive current account deficit. Now, moving forward from that, usually I get you to research your own country, take a look, see what you found. Here is a little exercise for you. Can you work out if there's a surplus or a deficit here? As you can see, I've split it into the 4 necessary sections. The answer is deficit 530. All right, moving forward. Here are the bottom 5 countries according to ChatGPT, which seems a bit wrong, minus 900 there. Don't know what's going on with that. But a lot of countries seem to have a big deficit. Now, let's have a look at the reasons for a deficit. Can you think of any? So the first is high import demand. Your domestic citizens really love products from abroad. If your currency is really strong, you're going to love buying from abroad even more because you can buy more for less. If your country loves to spend depending on the culture, this could also be an issue. And if you're growing rapidly and need resources, your country might be buying a lot more from abroad than normal. All right, so let's have a look at America's trade deficit with China. And can you make some notes on what might be causing this deficit?
Now, US President Trump is on his way out and his successor is preparing to take over. Experts are wondering, though, what will remain of Trump's policies? Take trade, for example, especially trade with China. Central to Trump's America First approach were policies to reduce the US's trade deficit with China. He introduced tariffs on $360 billion worth of Chinese-made products, but that seems to have failed in its aim. In November, China's global trade surplus skyrocketed to over $75 billion.
Okay, so we're seeing a huge surplus in China, right? Meaning they are selling more goods abroad than they are buying from abroad. And the idea of Trump putting a tax on China implies that less people would buy from China and that would worsen their current account. But it hasn't had that situation. People are still buying from China. Let's continue.
Most of that was led by the US, where exports to the US were up 46% on a year ago in November. The main reason for that is, of course, the coronavirus pandemic. With many Americans stuck at home, record amounts are being spent on a huge range of Chinese products. Meanwhile, American exports to China have improved, but only slightly. Agricultural products have sold well, but manufactured items have been badly hit by the pandemic. So let's discuss this with Laura von Daniels from the German Institute for International and Security Affairs, SWP. Welcome to DW Business. Great to have you on the program. So it goes against Donald Trump's stated aims, this increased deficit. But is it actually a problem for the United States?
Be ready to take notes.
Yes, it is a problem in terms of improving the trade balance, because at least that's what's been promised to Americans for more than 4 years now. And you might say that raging a trade war against China and even reaching something like the phase 1 trade agreement with China earlier this year in February didn't really improve anything about the trade balance. So maybe that wasn't the right metric to begin with.
How much can governments actually do, though? Because in this case, we've seen that consumers have essentially had the final say.
That's true. Maybe they cannot do so much about it after all. As I said before, raging a trade war didn't really change the situation. And some people say this is just the consequence of the pandemic, because people started to use their extra liquidity, not for services as they usually do for travel and so on, but they put it in, they channeled it to consumer goods more than they would have otherwise. But this has been a trend for more than this year, so it's been going on for a while. So, the question really is how much a government can steer trade relations.
Yes,
not so much, I would say.
Yeah, exactly. Can this current trend last?
So interesting. Her argument is if a country can stir relations in the right way, they can certainly improve their balance of trade. So it's about diplomacy, politics, and the complicated nuances of interaction between cultures. All right, let's move on.
Really? So
what's causing the deficit then? High import demand. The US is still buying goods from China. Even if the import taxes exist, the products are still cheaper than what would be produced domestically. The dollar's really strong right now. So if the dollar's really strong and China might be lowering the value of their currency using a managed float, then people are still going to buy. The taxes might not have that much of an impact. Also, America isn't producing these goods at the moment. It's China that's producing them. So they still need them. Some of these are essential goods for manufacture. And energy imports are still really important. Most countries are trying to get over their energy issues though, which is great. Now, the consequences of a trade deficit. Is it bad to have a trade deficit? What do you think? It can be. It can mean you're accumulating a lot of debt. You're buying so much from abroad. It means that your currency might depreciate because a lot of other countries have access to your currency. The supply of your currency is larger in those countries. Investors might be less willing to invest in you if you, as a country, aren't producing anything that people want to buy from abroad, although that might create an opportunity for investment if your salaries are low and your currency is low in value. So yeah, this overconsumption of things from abroad and not producing domestically might lead to further trade imbalances. And I think the third point here, vulnerability to external shocks, is really important. If all of a sudden a large customer like America decides, okay, we are not buying from China anymore, this would have significant impacts on the Chinese economy. And like we said, if you consistently buy abroad and don't produce domestically, it can lead to low employment, lower GDP, and loads of problems down the line for your country if there's no investment in growth or tech. However, the UK and the US have had a massive persistent current account deficit for years, and it's been pretty chill. That's because the currency might depreciate, foreigners will want to invest. You still have access to all these great markets for goods you might not be able to get domestically. If people are investing in your country, it could actually lead to economic growth and building capital and goods and tech. Now, so we know the UK imports more goods than it actually sells. There's a deficit. That if that money comes back into the country, it's fine. But if it doesn't, it can lead to a necessity to borrow or sell assets. How can a government effectively reduce a current account deficit? What can a government do? They can start by promoting tourism. Get more people over, get more people spending money in England. They can invest or subsidize the financial services industry and encourage them to deal with other countries. This should naturally depreciate the pound anyway, which could lead to greater investments in the country and also eventually stop people from buying abroad naturally because the pound's so weak. And there's lots of policies where they can do expenditure switching, make people buy domestically produced products, or dampening where people have a lower income and therefore can't buy things from abroad. Anyway, so they must encourage an increase in exports and reduction in imports and hopefully boost foreign investment. These are the three main things a government can try to do. And most governments in most countries do this anyway. All right, so let's have a look at Donald Trump, the man himself. What was his statement on fixing the current account deficit with China? Let's have a look. And I want you to think about whether it's a viable solution or not.
The Feds announced that China is selling $366 billion more merchandise to we Americans than we Americans sell back to the Chinese. $366 billion trade gap. Specifically, how will you fix that?
You know, this is my big point. I've been talking about it for years.
But I want to know how you're going to do it.
The number's actually higher than that. Well, listen to me. I'll tell you, okay? We are going to have to go. One of the reasons they're able to do it is they devalue their currency to such an extent. They are the single greatest currency manipulator that's ever been on this planet. And if they don't stop devaluing, we're going to have to charge them a tax on the goods coming in. They, by the way, Bill, just in case you don't know it, they tax our goods going into China. It's a totally unfair deal. And what's happened, every time they devalue their currency, they make it impossible and more difficult for our businesses to deal with China on the other side. The gap is getting bigger and bigger. It's really called the deficit. The deficit is getting bigger and bigger. And unless we have somebody very smart and very tough that understands it, and our president does not understand it, but I understand it better than anybody, we're going to have nothing but trouble.
So you're going to say to them,
505.
If
Bill,
you
it's going to be
continue to devalue your currency,
$505 billion this year.
I'm going to slap a tariff on all Chinese goods coming into the United States. Okay. They then are going to say to you,
yes,
President Trump, We are going to sell all of our bonds that we are holding for America's debt. We're going to flood the market with them and crash your currency. That's what a trade war would do.
No, they're not going to crash. No. They wouldn't crash. They won't crash our currency. They'll crash their economy. That's what they're going to crash. They start playing that. They will crash their economy. You will have a... Let me explain something. We're too dependent on China. We're too dependent.
So this is quite an important point, and I think Donald Trump does have an understanding of economics. I believe his degree is in economics. Now, so basically China buys bonds from the American government. This could be Chinese people, or it could be Chinese businesses, or it could be the government themselves, right? And bonds are basically an IOU. So they buy, I don't know, $100 of bonds from the American government, and the American government promises to pay back $105 in a year or two. Now, what the news anchor was saying is that China might threaten to sell all these bonds. And then Donald Trump said that would crash the economy. And Donald Trump is correct in this response, because basically, if I've already bought a bond worth $105, right? And then everybody in the market starts selling these bonds immediately before you claim that $105, the prices are going to get pushed lower and lower and lower. So the return on the investment from the investors that originally purchased it is going to get lower and lower and lower. So it won't do good for their economy. So Donald Trump is right in that state. So they're not going to do that. The only way they can really win that is by buying less bonds the next year as the government release them and forcing the government to pay higher interest rates. But they're codependent on each other anyway. Let's move on.
Let me explain the likes of which you've never, China. We're too dependent. They will have a depression the likes of which you've never seen if they ever did that. That's what would happen, Bill. I mean, you know what people don't understand in our dealings with China? We have the cards. They don't have the cards.
It's a high
Unfortunately, we
noon
have
fest.
political leaders that don't. We have the cards because they need our economy.
And that was a good specific answer, and I appreciate that.
Okay, then. So problem and what Donald Trump's proposals are. Okay. America has a huge deficit with China. That's a problem. Many Americans are buying Chinese products from overseas, and China are devaluing and manipulating their currency to keep prices low for Americans and keep the orders coming. And the deficit between America and China is getting larger. Basically, it puts a lot of American money into Chinese hands, which allows them to buy businesses and stuff in America. Now, what's his proposals? Okay, so they need to stop devaluing their currency, and America will have to increase import taxes if that doesn't happen. And Donald Trump has already done this. The things about this that would help, though, is it would increase government revenue, the import tax, and it would also allow domestic firms in America to compete and maybe even become competitive and sell their products abroad in the long run. It was argued that China could retaliate and sell their own bonds, but that would lead to a really difficult issue in their own economy as their investment products lose value, and loads of people would lose money and be unhappy and have low consumer confidence, which leads to lower spending. Donald Trump said it would crash the economy. Maybe not as bad as that, but it would certainly hurt the Chinese economy. Right, current account surplus then. Countries like Germany, Japan, and China have a huge current account surplus. Can you think of a problem like a country like Germany might have with a current account surplus? It doesn't seem like they would have one, right? It seems like a really good opportunity. But actually they do. Well, firstly, it can lead to trade tension. Other countries are going to be annoyed that you're soaking up all that revenue. And there's another problem with dependence. You know, the idea that other countries are so dependent on your product, it might lead to issues down the line. What if you run out of that product, or diplomatically you refuse to sell that product, as China has done with rare earth minerals to many countries? And it might lead to like an overdevelopment in certain sectors. And what if these sectors only last a certain amount of time? For example, it's mining cobalt or something. Something to think about. What are the solutions for this? So, get people to spend more. If they spend more, generally they'll start spending abroad. Encourage imports. Reduce tax on imports so external goods are more competitive. Work with other countries to address these imbalances, okay? Now, real exam question time. Explain 2 effects of a country having a surplus on the current account of its balance of payments. Pause the video and have a think. Okay, so 1 mark for each of the 2 effects. Output may be high, employment may be high. The exchange rate might increase because more people are buying goods from your country. Total demand in your country increases. It boosts a lot of things. So it looks like you're getting marks here for identifying any of these effects, up to 2, and then up to 2 for any of these explanations. So you're having a greater degree of exports than you are imports in terms of expenditure. And yeah, you see this employment point here. This just further explains it, like the process itself. More people investing in your country, buying your goods, leads to companies having more profit and therefore higher employment. Now, next one. Explain how a country could have a trading goods surplus, but a deficit on the current account. So you just got to remember the 4 components of the current account, and that trading goods is just one part. So let's see how we get our 4 marks for this. Trading goods surplus means exports exceed imports. Trading goods is only one part of the current account, as we just said. And simply identifying any of the other parts, primary or secondary income, gets you a mark. Now we need to explain it. There's a larger deficit somewhere, isn't there? And it's probably on the trading services or on something else. And giving an example of that gives you another mark. So yeah, you can talk about the primary or secondary having a larger deficit with an example, and that will get you all the marks that you need. And look at this one at the bottom. Just explaining simply factually what a current account deficit means also gets you the mark. So you can see here there's lots of methods to get full marks in this exam question. All right, that's it for me on the current account and the balance of payments for GCSE. Have a great day, and I'll see you all again.